which type of life insurance makes the most sense for me. We're going to talk about the 4 different types of life insurance and when they make sense for individuals, and this will all be based on individuals we work with and when we would recommend the different types of life insurance. So we'll talk about term life insurance, universal life insurance, whole life insurance, and then also institutional life insurance. Let's start with term life insurance. When might this make sense? So firstly, what it is. A term life insurance policy is a life insurance policy that lasts for a certain term. For example, you might get a 20-year term policy. What that means is you have life insurance protection for 20 years. Another way to put it is if you die within 20 years of buying that life insurance policy, a death benefit is paid out to your beneficiary. Now, you'll have a premium that is guaranteed not to increase for that 20-year period. A term life insurance policy is typically a very cost-effective way to get a large amount of life insurance for a low premium. So for example, you might be able to get a $1 million life insurance policy with a term of 20 years, and depending on your age, health, and several other factors, the premium might be $500 per year. Okay. So why someone would do this, there's several reasons. One could just be family protection. So your income might be $100,000 per year. You might have 3 kids. If you were to die tomorrow, would they continue to receive that $100,000 per year of income? No, because you passed. So if you have a $1 million life insurance policy in place, what that ensures is now they get $1 million. That is also paid out 100% income tax-free. And in order to get that insurance, you had to pay $500 per year. So what this provides is a very low out-of-pocket cost in order to gain protection in the event that something happens. So this makes sense for family protection. Another case that we see a lot of times is key man insurance, especially when a business does not want to dish out a lot of cash for a life insurance policy. We just had a case where someone was acquired, I should say a private equity firm came in, acquired some equity in a company. The individual is very valuable to the company, the owner that is, and they said, we want to have life insurance on him. We don't really understand whole life insurance yet, so we'd like to get a term policy. It was several million, and they spend a few $1,000s per year to lock in that term policy for him. In the event anything happens now, they're protected and they can look for a replacement for him because they've got the money coming in to do so. So that's where a term policy can make sense, as it provides a very low out-of-pocket to lock in life insurance that is very valuable. Universal life insurance. So there's 3 different types. There's indexed universal life, variable universal life, and then also guaranteed universal life insurance. Indexed universal life insurance is a product that we don't use. There's a number of reasons why. The main reason why is we have not seen any proof of performance when it comes to IUL policies, meaning they always look fantastic on paper, where if I'm selling it to you, I would say, look, you put money in, the cash value accumulates to $10 million down the road, and you'll be able to just live on tax-free income during retirement for the rest of your life. The problem is, when we look at the actual results of those policies, I've seen too many cases where they have just under-delivered. An example is someone who purchased a policy in 2008, and we actually studied his policy from when he purchased it in 2008 through 2020, a very strong bull run in the stock market. The illustration originally projected over that 12-year period an average return of about 5.5%, and then an annual return from 2019 to 2020 of more than 9%. What happened is when he hit 2020, his average return was 2%, and his yearly return from 2019 to 2020 was about 0.91%. So it projected beautiful numbers and under-delivered. And the agent who sold him that policy said, I set everything up for a high cash value for him. what had happened were things that were inside the insurance company's control, such as increasing the insurance expenses and decreasing the cap rates on the product, happened, which limited his earning potential, raised his expenses, and then he ended up with less money as a result. So when it comes to indexed universal life, or IUL, we've just seen that happen too much. Once we see proof of performance and really consistent proof of performance, then we might be more comfortable recommending that to those that we work with. But until that happens, we're not comfortable doing so, but we'll continue to keep an eye on it. There's also variable universal life insurance, which allows your money to be invested directly in the market. We do see some people do this. Where I see it the most is with what is called private placement life insurance. What this is having our money invested in mutual funds, stocks. I've got a wealth manager that's managing that money, but it's underneath the umbrella of life insurance, which means the cash value reaps the benefits that life insurance offers, meaning that growth can be tax-free and I can access it tax-free, which is very nice. And the death benefit can also grow to a large dollar amount, which when I die is paid out income tax-free. Private placement, however, is typically reserved for those that have very, very high net worths, where typically the minimum yearly premium, what I'm paying in every year, is 7 figures when you look at the average. So typically we see very large dollar amounts going into private placement contracts. But we have seen them work quite nicely just with the few examples I've seen over the years. And then you have what is called guaranteed universal life insurance. A guaranteed universal life insurance policy is a nice option if I'm just trying to lock in a death benefit. Typically, we see individuals who are working on an estate plan interested in this product. The reason why is because I can lock in a death benefit that's guaranteed to last forever at a low premium. I like to explain it almost like a lifelong term policy. My annual out-of-pocket is going to be higher than what I would spend with a term life insurance policy. However, with this guy, a guaranteed universal life insurance policy, the death benefit is guaranteed never to expire. And I can set it up that way from the very beginning. And with a guaranteed universal life policy, or we can call it a GUL, it can be set up where I have a very low premium that I pay forever. So maybe it's $10,000 per year that I pay until the day I die. Or I could set it up where I pay a very aggressive premium, a very high one, but for a short period of time. So instead of $10,000 per year forever, for call it a $1 million death benefit, instead, I might be able to pay $40,000 per year, but for 10 years, and then after that, I don't have to pay anything ever again, and I'm still guaranteed the same $1 million death benefit. So you can customize the product, again, if you're looking for a guaranteed death benefit. Then we have whole life insurance, which is really what our company has specialized in for a very long time, particularly when individuals are interested in the cash value. So when you look at the cash value of a whole life insurance policy, it is a safe place to put money that's very liquid. I can access it anytime. And if I do everything right, it's also tax-free. Why a lot of people are attracted to it is one, on the safety. Regardless of what's going on in the stock market, economy, it doesn't matter. Everything can just be going south. My cash value continues to appreciate over time. That's the first reason why people are attracted. The second reason is I can access it anytime I'd like without any penalties. And there's also a unique loan feature. How it works is if I have $10,000 in my policy, earning 5%, and I decide to borrow any amount, let's say it's $5,000, I'll still get that 5% interest on the full $10,000. Now, I will have a loan interest rate doing the $5,000, and we want to measure that and make sure that I'm not paying more in loan interest than what I'm getting, but my money keeps on working for me. Think of it like this. If you own a home, the fair market value appreciates by 5% every single year. You decide to take a mortgage out against it, you're still going to get that 5% appreciation on your entire home value, not just the remaining equity. So with a life insurance policy, you'll see that it works almost exactly the same way when we're looking at the cash value. So the second bullet point was I can access the cash value while it keeps on compounding for me. And then third, If I do everything right and follow IRS rules, which you don't have to worry about too much, that's mainly on the agent, it's all tax-free, which is sweet. At the same time, it is possible to mess those rules up if you're not aware of them, meaning on the agent side, which would result in it not being tax-free. But again, easy to do, and we can make sure that it's tax-free. There are two main different types of whole life insurance: traditional and limited pay. Traditional just means that the premium is due forever, whereas limited pay, an example of that might be a 10-pay policy where the premium is due for a maximum of 10 years. With some life insurance companies, you'll see that limited pay products offer higher internal rates of return or higher returns on the cash value compared to traditional products, which is nice to be aware of, especially if my main point of interest is cash value. And then lastly, we have institutional life. This could be corporate-owned life insurance or bank-owned life insurance. What this is a life insurance product that is only offered to institutions. It is viewed as an investment for them. So they're viewing it really, the cash value, the returns on the cash value, they're viewing that as an attractive asset on their balance sheet that goes nowhere but up over time. And then also the death benefit does have some value, meaning when the insureds, their employees in most cases, eventually die, the beneficiary is typically the bank or the corporation. So what a bank will do is say, okay, we've got some excess cash. We're looking at this life insurance product. It is earning a 4.5% return right now. We can also book that as a tax-free return. We're interested in that. So we can put cash inside of this product. It'll appreciate on the balance sheet. Sounds good. Then, when their employees eventually die, they get a death benefit back. How that's used is when they have employees, they're typically spending a lot of money on those employees. For example, health insurance premiums, 401k matches, and everything else that comes with the cost of having an employee. So the life insurance proceeds are used to recover those costs that the bank is dishing out year over year. So it has a short-term benefit via the cash value, which is also long-term because it keeps going up, but then also the long-term death benefit being, the long-term benefit is the death benefit coming back to the bank, income tax-free. So bank-owned life insurance makes sense for banks. Corporate-owned life insurance makes sense for corporations. If you are a small business owner and you want one of those products, sometimes they're available, corporate-owned life insurance that is. However, what we see a lot of small business owners do is typically get whole life insurance that is just set up for maximum cash value. And the reason why is because if we look at a bank-owned or corporate-owned life insurance product, in many cases they are classified as a modified endowment contract or a MEC, which means I'd have to pay income tax when I access it, whereas I don't have to do that when I look at whole life insurance. And a lot of small business owners value the ability to be able to access their cash value. So I hope this helps. If you have any questions, let us know. We'll talk to you next time.